Hey guys, welcome to Chapter 15, Financial Statement Analysis. We'll spend much time in this class discussing the shortcomings of GAAP prepared financial statements with respect to making internal decisions, such as how many units to produce. It is therefore important for us to understand financial statement analysis, which is this chapter, before we cover that other material, which will be the remainder of this course. So financial statements are used by parties to take a look at a company to see how many assets they have, how many liabilities they have, how profitable they are, and things of that nature. Remember, we have our income statement, statement of retained earnings, balance sheet, and lastly, our statement of cash flows. We're going to see that a financial statement, just one financial statement by itself, is not really so useful. But when we have other financial statements to compare it to, that information becomes way more valuable. So we're going to find that we're going to compare the company to its own track record. We're going to compare companies to other companies in the same industry, to competitors, etc. And when we do that, we can identify trends and have a deeper understanding of where a company truly stands economically. So let's take a look at this slide here. It says users analyze a company's financial statements using a variety of analytical methods. Three such methods are as follows. We have horizontal analysis, vertical analysis, and common size statements. Let's take a look here at horizontal analysis first. So the percentage analysis of increases and decreases in related items using comparative financial statements is called horizontal analysis. So basically we're looking at the performance in year 1, year 2, year 3. Okay, and we're going to look at the percentage increases and decreases between those years. We're able to determine any trends that way. Are things getting better? Are they getting worse? Are they staying the same? Are things stagnant? Okay, so let's take a look here. For example, let's take a look here at these current assets. We can see that in December 31st, at that year end in 2013, we had $533,000 of current assets. In December 31st, 2014, it went up to $550,000. So that's a $17,000 increase dollar-wise, or that's a 3.2% increase. Okay, we can see here, let's just, for example, take a look at retained earnings. Well, we can see actually up here there was no change, so there's no dollar or percentage change. Retained earnings increased from this number to $179,500. That's a $42,000 or a 30.5% increase. So just how did I come up with this 3.2% increase number? Obviously, the difference between these two is going to be the $17,000. And we can see here that we take this base year, December 31st, 2013, because we went from this base year to the second year. So we take the base year, put that in the denominator, and in the numerator we put the change amount. And so 17,000 divided by 533,000 gives us the 3.2% increase. Comparative financial statements are financial statements where we have multiple years side by side, so it makes it very easy to compare the differences and the changes between the 2 years. So take a look at this slide. It says the comparative cash and accounts receivable for a company are provided below. There's different amounts for 2012 and 2013. It says based on this information, what is the amount and percentage of increase or decrease that would be shown in a balance sheet with horizontal analysis? So what is the percentage increase from 2012 to 2013? Or percentage decrease in this case. Pause your screen for a second and then I'll show you the solution. Okay, so we divide the change by the base year. We're going to get 25% increase for cash and a 7% increase for accounts receivable. Let's take a look now at vertical analysis. We've already discussed horizontal analysis. So with the vertical analysis, it's a percentage analysis used to show the relationship of each component to the total within a single statement. It says here in a vertical analysis of the balance sheet, each asset is stated as a percentage of the total assets. Each liability in stockholders' equity item is stated as a percent of the total liabilities in total stockholders' equity. And in the vertical income statement, each item is stated as a percentage of total net sales. Okay, so this enables us to see the proportionate size of assets, liabilities, equities, revenues, and expenses. So this makes it handy when we're comparing companies of very different sizes. So here's an example of a vertical analysis of some comparative financial statements here. And we can see here, for example, total assets. We can see the intangible assets are 4.4% of the 100% total. Property, plant, and equipment is 39%. Current assets are 48.3% of our total assets. If we add all these up, these are our total assets. These are the components. If we add those all up, we get 100%. This is very useful, like I said, if we were comparing one company such as Walmart with a competitor such as Target. They're very different in sizes. Walmart is far larger in size. The figures in the Walmart financial statements are going to be far larger, but when we use vertical analysis and put everything here in this way, it makes it very easy to compare the two. So just how did we come up with this 48.3% figure here? Okay, we take a look at, remember, these are our total assets. So we look at our total assets, we put them in the denominator or the bottom of this equation, and in the numerator we put the 550,000 because we're trying to see what percentage of our total assets are comprised of current assets. When we divide those two together, we get 48.3%. Okay, so once again, all these added together gives us the 100%. And then we have all of our liabilities, and if we add all the 18.4 plus the 8.8 plus the 13.2 plus the 43.9 plus the 15.7, we're going to get our total liabilities in stockholders' equity. We can take a look here and take a look at the vertical analysis of the income statement. Notice here everything is based on net sales, 100% of net sales, right? Not sales, but net sales. Let's go back a couple screens and take a look. In a vertical analysis of the income statement, each item is stated as a percentage of net sales. So for example, if we want to figure out where this 12.8% came from right there, we look at our net sales, put them in the denominator, and put whatever it is. In this case, we're looking at selling expenses in the numerator, and we get 12.8%. Okay, this is 102.2% of net sales because our sales are going to be larger than net sales because we have to subtract out our returns and allowances. As I mentioned before, it's very nice and enhances the comparability of two financial statements of companies of different sizes when we're looking at percentages instead of dollar amounts. And so common size financial statements are going to be really helpful too. And so what this is a set of financial statements where all items are expressed as a percentage. Okay? So that's what a set of financial statements might look like comparing two different companies. One company could be far larger than the other, but once we're putting this and we're solely looking at percentages, it really makes it easier to compare and contrast the two. So users of financial statements are interested in a company's ability to meet its financial obligations. We call this solvency. Creditors are especially interested in this, and companies are also, or investors or users of information are also interested in the ability of the company to earn income or to be profitable. If it's going to be solvent in the long run and be able to pay those debts as they come due, there's definitely going to need to be some solid profitability as well. Let's take a look here at a solvency ratio. Working capital. You guys were introduced to this in the Principles of Financial Accounting class. So working capital is the difference between current assets and current liabilities. Okay, it tells you what would be left if the company used all of its current assets and used them to pay off all of its short-term liabilities. The more working capital, the less financial strain a company experiences. I want to point out here that the comparison between firms is of minimal value because of size differences between, let's say, Walmart and Target, and the use of these absolute values. So using numbers makes it difficult to compare the working capital using working capital to compare, let's say, Walmart and Target is kind of cumbersome because what is an appropriate amount of working capital for Walmart might not be for Target. Alright? This is an example of how we could calculate that. What's more useful when you're comparing companies of different sizes is the current ratio. Alright, so instead of current assets minus current liabilities, we look at the ratio of current assets with respect to current liabilities. The higher the current ratio, the more capable the company is of paying its obligations. So the stronger this number, the better. A ratio above 2 is considered healthy in most industries, but there's all types of weird industries out there, and what makes sense for one industry might be totally off the wall for another. Okay, but generally speaking, a increased current ratio would be something positive, something that we would be happy about. Have an example here for us. If WXY company's current assets are $50 million and its current liabilities are $40 million, then we would divide those two together and they would have a current ratio of 1.25. So that means for every dollar that the company owes for current liabilities, it has $1.25 available in current assets. There are a ton of ratios in this chapter, and I'm afraid that this video would get into the hours, maybe 2 hours, if we went into great detail about each one of these different ones. So what I'm going to do, I've picked out a couple that I thought were more important. I'm going to kind of scroll through some of these, so feel free to pause the screen at any time. And if something seems like it stands out as being a little bit more important, I'll stop and discuss that. Just remember here, guys, when we're talking about the days sales and receivables, and we're trying to understand and analyze our accounts receivable, just remember that the longer a receivable is outstanding, the less likely that it is to be collected. This ratio should mirror the company's credit terms, so if the company gives customers on average 30 days to pay, its days sales and receivables shouldn't be much more than 30. If so, then that might indicate that there's a problem with collection. So remember, excessive inventories expose the company to expenses such as storage costs, insurance, taxes. Things are stolen, destroyed, damaged. Lots of things happen when we have too much inventory, all right? So it's one of those things where we want to have sufficient inventory. We don't want to be stuck. At the same time, though, we don't want to be stuck with old inventory that's, like I said, costing us money, but we don't want to miss sales too. So there's kind of a sweet spot we have where we want to have just enough inventory but not too much. So having a high value here indicates that the inventory is turning over or being sold quickly, which is good, and a low figure for this means that it's turning over slowly, which would be something that's not good. Let's take a look now and discuss profitability analysis, and this is this focuses primarily on the relationship between operating results and the resources available to a business. So if a company is able to generate $1 million of profit using only $100,000 of assets, that's better than if a company generates $1 million of profit, but if it had $500,000 of assets to work with. So how efficiently, how effectively are we using those assets to generate profit for the company? One of the ratios here that we're going to start with here is the total asset turnover. Let's discuss the rate earned on total assets. This measures the profitability of the total assets without considering how the assets are financed, either through the sale of equity or debt. This ratio includes long-term investments in the denominator, because the income from these is included in net income. Now, you might notice in some of these ratios that we add back interest expense. Now, the reason that we do that is we've discussed in Accounting 120 and Principles of Financial Accounting, capital structure, the usage of debt or equity to finance a company can have impacts on the financial statements. You could have two companies that would otherwise have performance that could be exactly the same, but because one of them chose to finance themselves through debt, there's going to be interest expense. So the reason we're adding this back here is we're trying to make it more, we're trying to enhance the comparability. Financial leverage is discussed again at this point. You should remember seeing something like this from our Principles of Accounting class. And so financial leverage is the amount of debt that the company has in its capital structure. The more debt that it has, the more leveraged that it is. Okay, and so the more leveraged a company is, the more wildly the earnings per share is going to swing with an increase in sales. Okay, it's kind of like, let's think of it this way: the more debt we have, we can make more money because we've borrowed money, but we can also lose more because we've borrowed more money, right? Problem with having borrowed a lot of money, though, is that we have to repay those amounts, right? We have to repay that amount, and we also have to pay interest on it. It doesn't matter if times are good or if times are bad. When times are bad, we still have to service that debt, meaning we have to make those payments. And if a company is struggling to keep afloat, that can really be burdensome. It can actually sink a company. So having equity, having raised money by selling ownership in the company, can be good in some cases because we don't have to worry about servicing that debt. But then on the other hand, we're selling off part of the company, part of the rights of ownership. And so, it's hard to know what is the best course of action. Most companies, though, do have a capital structure that includes both debt and equity. All right, so you might need to take a second here to pause this slide here, but we have a couple different plans here. This came from an earlier chapter in your book, but what I want to point out here is over here on Plan 3, this capital structure has more debt in it. Okay, and we can see here, like I said, go back and refer to, I think it was chapter maybe, it was chapter 12 of your book. If you go back, you can review it there. You can also review the YouTube video that I've prepared on capital structure. But what we'll see here is this earnings per share on common stock. Plan 3 has more debt, and we can see that there is a larger difference from 25 cents per share to $4.45. That's a way greater change than over here from $2.25 to this drop to $1.20. So this is more wildly, it reacts more wildly. Okay, and that's because of the existence of that debt and the fixed nature of the interest payments that go along with having that debt. Like I said, you could spend the better part of an afternoon just looking through these ratios. There are tons of them. And another thing to keep in mind is that these ratios, the way they are actually calculated, might vary from source to. So for some of these we see listed here, there might be a slight variation where it could, for example, this rate earned on total assets. One calculation that one source might use might exclude interest expense. One might add it back. It really varies. So you need to understand how these ratios are calculated. Let's take a second now and discuss corporate annual reports. So in addition to the financial statements and the accompanying notes, remember the footnotes are what go behind the financial statements that provide us detail with respect to all of those numbers that are on the front of those, or the face of those financial statements. We also have, in addition to that, this corporate annual report, and that's going to include the following: management discussion and analysis section. A report on the adequacy of internal control, right? Remember that from Chapter 7. Reports on the fairness of the financial statements. Are they prepared in accordance with generally accepted accounting principles? Feel free to pause the screen here to learn a little bit more about the MD&A section of the financial report. After Sarbanes-Oxley Act of 2002 was passed, it requires auditors not only to audit the financial statements, but to also take a look at the internal controls to make sure that there is there are controls and procedures and policies in place to prevent something from happening that would materially impact or change the financial statements. And also to discover that if something were to take place, something should be control should be in place to discover it before it carries on for years and years and years without being discovered. So the report on the fairness of the financial statements, that's going to be the audit opinion. We have unqualified or a clean opinion. This is good. This is saying that the financial statements are fairly presented. Okay, this is what companies strive for. Qualified, or if financial statements have some type of qualification, that means that except for one or two little things, for the most part, the financial statements will look good. Sometimes a disclaimer of opinion might be given. Perhaps the company would not provide adequate documentation with respect to inventory, for example. And the auditing CPA firm could not express an opinion, so that they would have no choice but to have a disclaimer, meaning that they could not give any opinion. And the worst thing would be an adverse opinion stating that the financial statements are not fairly presented. So the CPA firms and the companies are talking throughout this whole process, and if the CPA firm finds what they think is a problem, they can tell the company to go back and make the change. They say, hey, we think that this is not presented fairly in accordance with generally accepted accounting principles. You guys need to go back and change it to make sure that it's presented fairly. If the company goes on and makes those changes, there's not a problem. If the company refuses to make the changes, well, we're going to either have, if it's just maybe one minor thing, a qualification. If there are several large items, then we might be looking at an adverse opinion. If an investor sees that there's an adverse opinion on financial statements, they are going to not trust those financial statements. They're going to question every single number that's in there. So it's important for a company to have an unqualified or a clean and fairly presented set of financial statements. Take a look here to learn a little bit more about what a financial audit is. We get down to the bottom here, we're going to see that under this testing system, assurance can never be complete, and that the final audit conclusions are subject to this inherent probability of error. We can't look at every single transaction, right? So we use statistical sampling to look at transactions and to follow them all the way through the accounting system, but there's always the possibility that something is going to go through undetected. I hope this video was helpful. I apologize for kind of breezing through some of the financial ratios there. There's so many of them. I think the best thing to do is just kind of pause the slideshow or the video at each different slide, take a look at it, read it, see if it makes sense. If you have any questions on any of this stuff, remember, I'm a phone call, email, or office visit away.